Paul, the stock market in April was absolutely awful. Tell me what happened.
Things started to capitulate. All of a sudden, Facebook announced things towards all this year has been a lot of bad earnings, bad projections for the future, people missing. It's causing stocks to fall. But remember, we've talked about this channel since day one. Everything is rosy and great until it's not. And when things are hyped and things are exciting, you can see these big drops. I mean, look at Netflix, for example. This is a company that hit $700 a share. And what's Netflix at right now? $200 a share? And it was only $700 6-7 months ago. When things are overhyped, on the upside, they'll be overhyped on the downside. Does that mean these companies are all buys now? Not necessarily. But when people get scared, they get scared in masses. They all try to exit the fire in the theater at the same time. There's only one door to exit. So when everybody's trying to get out of it, what's going to happen to the stock price? It is going to plummet.
So the Nasdaq was down 13%, its worst performance since October 2008. But you're very pleased.
I am pleased
with your Nasdaq short. So while the rest of the world, they're holding their head in their hands and wondering how much money they're going to lose, you've been very adamant that you sort of saw this coming, or at least expected it.
So remember, timing the market's impossible. But my job as a value investor, and probably the reason why you're watching this video, is because you want to understand why prices go down. So the big thing for me is understanding how you can lose money will make me better at understanding how to make money and vice versa. So on this channel, that's exactly what I'm trying to do. I'm trying to explain the idea that every investment's the present value of all future cash flow. I don't look at the stock price as my indication that I'm right or wrong. I look at the fundamentals of the business and paying a good multiple of that as the way in which I see that the stock that I've bought is at a good value. Could it still go down? Absolutely. But if I pay the right price now, then in the future, as it goes along, over time, the stock will do the price that I want it to do, and I'll make my money. Now, with all the high-flying hype stocks, which a lot of them are in the Nasdaq, their assumptions of stock price, we're assuming these insane projections in the future.
Yeah, you share these thoughts with Warren Buffett in the Berkshire annual meeting. He compared this to gambling.
It is
parlor gambling. A lot of speculative plays. What does that mean?
Well, we did a video recently about Cisco, and we put it in our stock analyzer tool to see what it was said. Now, Cisco, if you know anything about our stock analyzer tool, it takes your assumptions about the future and tells you what price to pay for the stock today. In Cisco's case, we took the previous 10 years before the 2000 crash. Now, remember, the reason I brought Cisco is Cisco was written and said it will be the first $1 trillion company. And in the article where it's written there, the guy actually writes, this analyst says it'll be the first $1 trillion company, and you'll be hard-pressed to find anybody who disagrees. Does that sound familiar to today?
Yeah, it sounds a lot like a Bitcoin
it does.
And Tesla, yeah.
The company has yet to hit $1 trillion. In fact, it's about 200-some billion now.
210 billion.
210 billion.
20 years later.
And it fell 90% from its peak before it even got to this point. Now, the interesting part about Cisco is the previous 10 years, the revenue growth was 75% per year. So somebody would be conservative saying, hey, 20% going forward. Guess what? It did 8% revenue growth. And that's what we're trying to teach here. Everything's based on your assumptions. The goal is to make conservative assumptions and buy companies that are selling for lower prices. So what does that need? It needs people to bail. It needs lower prices. April was the start of that. This year has been the start of that. We needed these FAANG stocks to come closer down to reality. And some of them have fallen a ton. Like I said, Netflix is down, 70% since its peak 8 months ago? Incredible. Who would have thought 7 or 8 months ago that Netflix would fall 70, 80%? I wouldn't have thought it'd happen that fast. But did I think? I think if you go back and look at our videos, I did look at it and say, listen, this stock has to fall a lot because the present value of all the future cash flows cannot be justified with this price. And that's the way it should be for investment. You should look at it and saying, what am I paying today for this future cash flow stream to me or to the company of which I own part of? That is the important part of investing. And if you found this channel and you stuck around long enough, you will see that as we go along, and I'll explain the rest of the video what I think is going to happen in the future, that you will get a mindset of looking at an investment as looking at a stock as buying a piece of a company, not buying some ticker symbol to go up and down.
Yeah, so the question is, where is all this headed? Now, you're usually hesitant to say, I have no clue. But in essence, we have seen the studies, Buffett Indicator, that times have been so great that the next decade certainly could look very bleak. So what do you think is going to happen?
Now, correction there, Seth.
Go on.
When somebody asks me, Paul, where do you think the market's going to go in the next year? I refuse to make a comment because I have no idea. But when it comes to longer periods of time, I can probably say some things. In the next 10 to 12 years, mark this on YouTube right now. the stock market will be lower 10 or 12 years from now than it is today.
That scares me as a normal
I do believe that is the case. The most reliable metrics in history show that the stock market will be lower 10 years from now than it is today. If you think that's crazy, look at every market top in history, every secular bull market top. 2000, the S&P peaked at 1,500 or whatever it was. 10 years later, it was well below 1,500. And the projections were for losses along the way. It got very close in 2007. Maybe it surpassed it slightly, but in 2010, 10 years later, it was lower. I think the same thing's going to happen today.
Yeah, so if that sounds astonishing to a viewer like you at home, if you look at the graph at Cisco, it has still, Paul, never reached its heights. If you would have invested and followed all those people saying how wonderful this was, you've lost money over the past 22 years, which is kind of hard to do.
If somebody had written that article and you told the masses, guys, 22 years from now, Cisco will still be lower than it is today, people would be like, you are absolutely bonkers. You're an idiot. You're stupid, you're dumb. Sound familiar? That's what I hear from the average noobs and the YouTube celebrities who made money on one stock that was a high flyer. When your neighbor's kid is talking about investing, be cautious. When they're talking about Bitcoin, be cautious. My projections for the future are, some would say, very dismal. I'm not a negative person. I'm a very optimistic person.
Yeah.
But I make those decisions based on where valuations start today. The more you pay for something today, the less return you'll get. It's just math. If you know you're going to get $10 a year for the next 10 years and you pay $200 for that $10 stream, you're going to lose money. You're paying $200 to get $100 over the next 10 years. If you pay $5 for it, you're paying $5 to get $100 over the next 10 years. That's 20 times your money. It's just math, guys. What you pay today will not affect the performance of the business over the next 10 years. But what it will do is it'll affect your return on investment. And that's what we're here to teach. That's why you're here watching this video.
Yeah, so Paul, a sign for all this is this Buffett Indicator. Explain to the viewers at home what this is.
So the Buffett Indicator is considered the most reliable, essentially Buffett says the most reliable metric, stock market to GDP at any given time, okay? So right now it's at roughly 200%. In the 1982 bear market, it hit a low of 32%. Today, it's 200%, 2022. So what does that mean? Every dollar of profit is 6 times more expensive today than it was back then. So if you wanted to buy $1 of profit, if you had to buy $1 profit today for $30, you're buying it for $5 back then. Doesn't matter about inflation. So I hear somebody say, well, yeah, but the cost of living has nothing to do with it because these are ratios. Ratios take the cost of living out of the situation. Now, it makes perfect sense then that the less you pay for $1 of revenue, the better you'll do. Does it not? And that's what I look at when I talk about the next 10 years. The next 10 years, the next 12 years in this market are not looking good because of where we stand today. You're paying too much for every dollar of revenue and profit. Guess what? I used to do the same thing. Because I was like, well, everybody out there loves these stocks. We all believe in the herd mentality. It feels good to believe in these things. But at the end of the day, our job as value investors, our job as investors in general, is to pay as little as possible for reliable earnings and revenue that we can project out in the future. If we can't do that, we need to avoid that investment. And right now, overall in the stock market, you can project things out. We know how the U.S. economy will probably do over the next 10 years. Remember, we have inflation coming up. That's going to hurt people's buying power. It's going to hurt the economy. These are the things that are playing in. I don't worry about those things, but over long periods of time, it is much easier for me to say, you know what? The U.S. economy will probably grow between 2 and 4% a year for the next 10 years. And based on where we are in the stock market value relative to GDP, like Warren Buffett talks about, we are paying too much for stocks today by a big amount. We want this 200% to be 60 to 70% for good buying power. That's how good 1982 was. It was half the even good level of buying. And that's why you saw, go look at the returns between 1982 and 1992. And look at the returns between 1982 and 1997. They are huge. Why? Because you paid so little for them. Anytime in history that we get 120% or above, the next 10 years are bad. And guys, we're at 200% right now.
So Paul, this confuses me and maybe our viewers, is the concept of, you're telling me it's going to be very bad for 10 years, but then you're also telling me to keep buying every month. So what's it going to be? How does this work?
Warren Buffett can't even time the market.
That's true.
The best investors ever cannot time the market. Your job is to sit there and buy at all times to get the averages. So this is the stock market's value over time, the straight line up away. There's going to be ups and downs in the market price, but all along the way, the average is going up. Your job is to buy all along the way. And guess what that means? You're overpaying sometimes, you're underpaying. But over long periods of time, you're paying exactly this amount instead of having to worry about timing the market. It's an easier way to live. Keep investing, and you will at times buy when prices are so devastatingly low, it's going to be ridiculous, and you're going to buy sometimes when it's high, but just realize that you're underpaying and overpaying, but the average is what you're doing, and it's more important for time in the market than timing the market. That's the important part here, and that's what I encourage everybody to understand.